Hey everyone, in this video, I'm going to bring you one beaten down growth stock that's down 81% off its high that I think makes an excellent purchase for 2024. I'm going to look at some of the recent developments at this company. I'm going to look at its longer term trends in terms of cash flow and operating profitability. And then I'm going to look at its valuation and weigh it against its prospects over the next few years, bring it all together and let you know all the reasons why I think this stock makes an excellent investment. So let's jump right in. Let's see what this company is.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so the company I'm talking about in this video is Penn Entertainment, the company formerly known as Penn National Gaming. This company operates a string of local brick and mortar casinos, and it's investing in mobile gaming, sportsbook, and iGaming. And I think the combination of those assets is going to lead to solid investment returns over the next several years. Now, recently, Penn estimates that in 3 years, it's going to generate significant cash flow. Right now, it says it has $1.32 billion in cash. It's going to generate $1.72 billion in cash flow from operations from the brick and mortar casino business. It's going to reinvest $225 million in maintenance capital expenditure, right, for upkeep and things of that nature. And then it's going to spend about $300 million investing in the mobile side of the business, the mobile gaming, sportsbook, and iGaming. And then at the end of those 3 years, it's going to have $2.514 billion in cash. So over the next 3 years, it's going to generate over $1 billion of increase in cash. Solid growth to be sure. Also, recently, you may have heard Penn Entertainment made a deal with ESPN. In my opinion, Penn Entertainment overpaid. ESPN's going to get $1.5 billion in cash over the first 10-year term for media and marketing services and the use of its brand and other rights. And ESPN's going to receive approximately $500 million in warrants upfront and additional performance warrants upon achieving various targets. So ESPN's going to receive about a $2 billion compensation for Penn to receive the rights to use ESPN's namesake brand and other media and marketing services. Now, ESPN is the most popular brand in sports, so Penn is getting significant benefits in return. Also, this is over a 10-year term. So if you look at the $1.5 billion, that's $150 million per year over 10 years. So it's not 1.5 billion every single year. So given the size of the market opportunity, I feel like they overpaid. The North American, or let's say US, mobile gaming market is estimated to reach about $30 billion by 2030. And so you're paying $1.5 billion for a partnership when the total market opportunity is going to be $30 billion annually. I guess if you feel that this partnership is going to give you stronger market share and stronger profitability, that's good. I prefer this partnership over spending money on incentives and promotions, which Penn has been pretty disciplined with. Unlike other providers, Penn hasn't offered the kind of online promotions and incentives, and that gets your customers in a bad habit. While they expect you to always offer them a promotion to put money on your website, they won't put money on the website until they get a promotion. Sort of like how I use Uber. Uber Eats sends me so many promotions that I don't order from Uber Eats unless I have a promotion. And so you don't want to train your customers that way. And I prefer the branding relationship over an incentive promotional spending for Penn. Nevertheless, despite my opinion that they overpaid, Penn has solid prospects. Longer term, Penn's operating income over the trailing 12-month period at $797 million is higher than even before the outbreak, where it was generating close to 600 million in trailing 12-month operating income. So the company was devastated by the pandemic. Of course, it had to shut down the local brick and mortar casinos for in-person gaming for several months, maybe over a year in some locations, but it got them back up and running, and they're doing better than they were before the outbreak, as people are unleashing this pent-up demand for away-from-home experience, and gaming and gambling has been one of the more popular pastimes ever since the economic reopening gained momentum. Additionally, the company's generating strong cash flow, 658 million in cash flow from operations in the most recent trailing 12-month period. Again, above the rates it was generating before the outbreak. So the company overall is doing better than before the outbreak, even though it's investing hundreds of millions of dollars into the development of the online gaming segment. So it's not only generating strong cash flow from the brick and mortar side, but it's also investing in the digital side. I think the two sides work well together, will work well together. There's opportunities for cross-selling, right? The people that come to your local casino, you can market your online sportsbook, and the people who play online and that haven't visited your casino, you can send them emails asking them to come to your local casinos. And so that's a customer that prefers, that likes gaming, that likes gambling. And so you can cross-market, cross-sell. The opportunities are there to benefit from that integration. I like this strategy longer term in terms of the profitability prospects for the business. Analysts tend to agree. What I have here is Penn Entertainment's revenue and earnings per share forecasts. Revenue is on the top line here. 6.55 billion in revenue is expected for fiscal year 2023 when it's all said and done. That's going to grow to 6.7 billion in 2024 according to estimates, and that will grow to 7.06 billion in 2025 according to estimates. Earnings per share is going to grow from a negative 89 cents to 49 cents in 2024, and it's going to more than triple to $1.53 in 2025. So 2023 may have been a difficult year in terms of profitability, but the company is expected to rebound strongly over the next 2 years. Finally, Penn National Gaming is not trading expensively at a price to free cash flow of just 12.03. I feel that the stock is undervalued, and for all of the reasons I mentioned in this video, I think it's one growth stock that investors can feel good about adding to their portfolios for 2024 and beyond. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.